Warren Buffett heavily buys into Japan's top 5 trading companies. These 5 companies are Mitsubishi Corporation, Itochu Corporation, Mitsui, Sumitomo Corporation, Marubeni Corp. As of the end of March this year, the net profit for the 2022 fiscal year of Japan's top 5 trading companies was 4.2 trillion yen, which is more than 4 times what Buffett invested 2 years ago, and the share prices have hit multi-decade highs. What kind of businesses are Japanese trading companies? How are specialized trading companies and general trading companies different? What are their business operations? What is a trading company? What are the differences between specialized and general trading companies? Firstly, let's understand what a trading company is. In Japanese, trading company means a trading firm, so in the understanding of Japanese people, a trading company is a company that sells products or services from country A to country B. Trading companies are divided into specialized trading companies and general trading companies. Specialized trading company concentrates on a specific industry. A specialized trading company is a trading firm that concentrates its main business in a specific industry, such as Kato Industries, which specializes in food trade, annual turnover of 1 trillion yen, or Kokubu, annual turnover of 1.8 trillion yen. Other examples include Nippon Steel and Sumikin Bussan, which focuses on steel trading, annual turnover of 2.5 trillion yen, Osaka and Kojo, annual turnover of 2 trillion yen, Okaya and Company Ltd., which is focused on machinery trading, annual turnover of 900 billion yen, Marubeni, which trades in semiconductors, annual turnover of 300 billion yen, and Nagase and Company Limited, which specializes in chemical product trading, annual turnover of 800 billion yen. These specialized trading companies, despite focusing on specific industries, have large turnovers, each exceeding 100 billion Taiwan dollars. General trading companies trade everything. General trading companies are the main focus of this conversation. They are a bit difficult to describe. When I first joined the company and was asked what we sold, it was genuinely hard to answer. Why? Because we sell nearly everything. If we categorize the products of trading companies, they can be broadly divided into 9 categories. 1. Metal-related products, like steel. 2. Energy and resource products, such as oil, mining. 3. Machinery products, processing, machinery, factory design. 4. Shipping and aviation transportation products, cars, ships, airplanes, space aviation. 5. Infrastructure products, dams, tap water, power plants. 6. Chemical products, semiconductors, chemical raw materials. 7. Lifestyle industry products, forestry, construction, food, clothing. 8. Living service products, media, retail, medical, internet. 9. Financial products, installment payments, venture capital. As times change, trading companies also enter new industries, and once they get a foothold in the industry, they will slowly advance upstream and downstream of the industry. The business of a general trading company is like a miniature version of a country's industries, with everything included, which is why new hires at trading companies usually struggle to explain what their company does. I just introduced several representative trading companies in various industries, so what are the general trading companies? Generally speaking, the top 5 general trading companies are the following 5: Mitsubishi Corporation, Itochu Corporation, Mitsui, Sumitomo Corporation, Marubeni Corporation. The scale of these 5 companies is much larger than that of the specialized trading companies mentioned earlier due to the comprehensiveness of their businesses. Because they also invest more, their assets are quite large. Looking at the market value of these 5 companies in terms of stock prices, from highest to lowest, they are Itochu Corporation with 4 trillion yen, Mitsubishi Corporation with 3.4 trillion yen, Mitsui and Company with 3.0 trillion yen, Sumitomo Corporation with 1.5 trillion yen, and Marubeni Corporation with 1.0 trillion yen. So when the Oracle of Omaha, Warren Buffett, said he wanted to invest in the 5 major trading companies and hold more than 5% of the shares of each company, he would have to prepare about 2 trillion Taiwan dollars to start buying 5%. Instead of saying that trading companies are big, you could also say that Buffett is very wealthy. So why would Buffett want to buy shares in trading companies? Do these companies have any astonishing features? Unveiling Buffett's investment motives from wheat. In order to help you better understand Buffett's motives, let me further introduce the evolution of the business model of trading companies. As I mentioned earlier, the term trading company in Japanese refers to a trading company, but in fact, trading companies have also been transforming, gradually extending their profit model from trading activities to investment activities. This can be explained with the product flour. Model 1.0, starting from trade, buying wheat from the US and Canada and selling it to Japanese flour mills. In the era of trading company Model 1.0, trading companies would buy wheat from grain merchants in the United States or Canada, and then sell the wheat to flour mills in Japan. However, because the nature of the product does not change from purchase to sale, it's all wheat, the added value provided is not high, leading to a gross margin of less than 1%. But because the quantity of such bulk commodities is quite large, even 1% amounts to a stunning sum. Model 2.0, from trade to investment, directly investing in upstream grain suppliers and downstream flour mills. Moving into the era of the 2.0 trading company, these companies gradually realized that in fact their suppliers, or customers, were making a much better profit margin than them. At the same time, in order to control grain suppliers and secure exclusive distribution rights, trading companies began to buy shares in grain suppliers. Currently, the second largest grain merchant in North America has been acquired by a Japanese trading company. This does not include other small and medium-sized grain merchants that have also been acquired. After buying their grain suppliers, trading companies can secure selling rights not only to Japan, but also to other countries, thus expanding their sales channels to many countries. Returning to the customer side, this wheat still needs to be sold to Japanese flour mills. However, if one day the Japanese flour mills no longer buy wheat from the trading companies, the grain businesses they invested in the United States would be in trouble. To prevent this problem, trading companies have invested in large Japanese flour mills, such as Showa Sanjo, Nissin Siphon, Nippon Flour Mills, and Chiba Flour Milling. Almost all of the top-ranked flour mills in Japan have a considerable proportion owned by trading companies. When the trading company becomes a shareholder, from the grain merchant that produces wheat at the source to the flour mill that purchases the wheat, they indirectly become part of the same family. This makes the integration of upstream and downstream industries much more convenient. Model 3.0, touching consumer life, investing in the production end, bread factories. But later, trading companies slowly realized that they were doing B2B, business-to-business, transactions. Although B2B is simpler and more stable, it is difficult to have contact with consumers, and the gross profit is lower than that of B2C products. The trading companies thought that if they could have contact with consumers and start from product design, they could have a greater impact on consumers and suppliers. One of the biggest customers of the flour mill is the bakery, which is a B2C business. The largest bakery in Japan is Yamazaki Baking, so Japanese trading companies each hold a certain stake in Yamazaki Baking. The starting point is not only to understand the trends and development of bread, but also because Yamazaki Baking purchases a lot of flour. This move by the trading companies can also make the upstream suppliers' flour mills nervous, which would make the relationship between upstream and downstream more long-term and intricate. In fact, many special varieties of wheat that are difficult to develop rely on this trust relationship to be incorporated into the bread. So in development, trading companies can indeed help the upstream and downstream supply chain a lot. Model 4.0, trading companies in daily life, retail channels are also within the investment scope. So far, we've talked a lot about flour. Does that mean we don't see the activities of trading companies in other consumer industries? As it has become popular for trading companies to get involved in industries that have contact with consumers, they have moved into the consumer market. Convenience stores like Lawson, Family Mart, and 7-Eleven, in fact, all have some level of shareholding from trading companies. Even convenience stores, which are downstream customers of Yamazaki Baking, have entered the investment scope of trading companies. This shows that trading companies have evolved from selling raw materials in the past to now becoming the invisible enterprises in our lives with Model 4.0. In the pandemic era, investing to diversify risks is the best strategy. Indeed, the news of Warren Buffett buying shares in trading companies was somewhat surprising. One might wonder why he would choose to invest in such diversified and relatively conservative companies. Because trading companies invest in such a variety of areas, their internal controls are relatively strict. While strictness does not mean that they can filter out 100% of risks, the fact that they can make hundreds of billions of yen in profit per year must have a lot to do with this strict internal control mechanism. However, after the above explanation, everyone should understand that the target companies of Buffett's investment this time, in addition to operating in diverse industries, also have a very even distribution in the upstream and downstream of the industry. I think in this uncertain era of the pandemic, it's more practical to put money into diversified companies to spread the risk. Although there won't be high growth, the assets are distributed all over the world, and the diverse combination is certainly not a bad choice.